Hello, thanks for stopping by for the weekly real estate market report. This week we're going to talk about the economy in general, the real estate market in particular, mortgage interest rates, and what the Fed is doing to royally screw up the entire situation. On the economy, I'm seeing a number of reports that are describing it as strong. I think I would personally describe it as stable. It looks like the gross domestic product for this year is going to have a growth rate of about 2.0 to 2.2%. And that is not what I would describe as a strong economy, but certainly it's a lot better than negative growth because nobody wants a recession. Two areas of the economy that are showing quite a bit of strength are retail sales and also employment. For September, retail sales rose 0.7% over August, and that's more than twice what was expected. The predicted number was 0.3%. And I had a little bit of personal experience with that a few days ago. I went out to the mall to pick up a couple of cables for my computer and was pleasantly surprised. The place was pretty crowded. And we're not even into the Christmas season yet, so that is showing some strength, and I'm as guilty as the next one on this, but especially considering how many people are ordering stuff online. So as I say, I was pleasantly surprised to see that many people out shopping locally. On the employment situation in September, we added some 336,000 new jobs, and again, that's almost twice what was being predicted. So that remains a strong area of the economy as well. Unemployment is holding steady at 3.8%, and the labor participation rate is also holding steady at 62.8%. which is a good number. I'd like to personally see it a little higher than that. I think in recent times, 63.8 is about as high as it's gotten. But, as I say, 62.8 is not a bad number. It's certainly a lot better than, I think it actually dipped down to 60%. It was somewhere around April of 2020 in the middle of the pandemic. So we've been seeing a steady increase in the participation rate since that time, and that's certainly a good thing. Now also, as I mentioned last week, there are over 9 million active job openings in this country. So in my humble opinion, there's really no excuse for anybody that wants a job not to have one. One problem area with the economy is inflation. It remains stubbornly high at 3.8% core inflation. And of course, that's well above the 2.0 target that the Federal Reserve is shooting for. So that's certainly not good news. And I'll get more into that when we reach our discussion on the Federal Reserve. Moving on to the housing market, as predicted, September sales fell below the 4 million annual rate for existing homes. Now, it wasn't a lot below 4 million, I don't remember the exact number, but it was just barely below 4 million. That, however, does not mean a drastic reduction in buyer demand. Now, buyer demand is becoming a little soft, but it's still there. In September, the average number of offers on a home sold was 2.6. Now that's down from the 3.1 in August, and it was 3.5 back in July, but both of those figures are well below the 5.5 offers that each house was receiving back in April of 2022. Now this drop in buyer demand is certainly not surprising. Many people are getting priced out of the market, either because they've decided that prices have just gone too high too fast, which I agree with, by the way, or they just can't qualify for a mortgage anymore at these interest rates, frequently because of debt-to-income ratio. In September, 26% of the homes that sold went for more than their original asking price. Now that also is down. It was 31% in August and 35% in July. But if we look back to April of 2022, it was 68% at that point. In September, 69% of the homes on the market sold in less than 1 month, and that's down from 72% in August. But again, if we look back to April of 2022, it was 88% at that point. In September, 29% of the home purchases were all cash, and that equals the 2023 high of January. 27% of buyers waived their inspection contingency, and that's up from 23% in August. And the reason a person would waive their inspection contingency is they're afraid of losing the house to someone else. And as I say, with 2.6 offers, that's still a seller's market and still a good possibility. If you don't have a strong offer, you're not going to get the house. Now, I really hate to beat a dead horse, but in this case, the old nag deserves it. If we look at this chart here, we'll see the reason for the low inventory. This chart shows us the percentage of existing mortgages that are at or below a particular interest rate. And I'm going to start at the right-hand side of the chart because that makes the most sense. If we look at that, 23.5% of all mortgages are at or below 3%. Moving one column left, we'll see that 62% are at or below 4%. And for the 5% mortgage, 82.4% of all existing mortgages are at or below 5%. And that, in a nutshell, explains the lack of inventory on the market. Nobody wants to sell their house if they have such a low mortgage rate and have to replace it with something that is well above 7%, and we'll see just how much well above in just a minute. And pretty much, I don't know if I can say the only people that are selling at this point are people that absolutely have to for one reason or another, such as getting relocated for work or what have you. But generally, people aren't selling unless they have to. Now, if we look at this chart, we'll see that inventory is starting to rise, and that's a good thing. However, we got to bear in mind that it is the season. Traditionally, inventory starts going up this time of year, and I will point out that even though inventory is increasing, it is still well below a normal level. Nationwide, we have about 700,000 existing homes on the market, when normally we should have about 1.2 million. Now, if inventory continues to rise and does so rapidly all the way through November, then that would indicate to me that there is a weakening of buyer demand. So we'll just wait a couple of months here and see what happens. Now, also of note is the median list price, and that is on the decline as well, currently standing at about $430,000, down from a peak of $450,000. However, again, it's the season, so normally at this time of year we do see a pullback in prices. So in order to say we've got a trend, we're going to have to see a sustained reduction in prices along with a sustained increase in inventory. Then we can say we've truly had a shift from a seller's market to a buyer's market. But personally, I don't think that's going to happen until interest rates drop down to at least the 6% range. And I don't think that's going to happen anytime real quick. Now, this entire situation is hammering the confidence of both builders and realtors. The builders' confidence index fell another 4 points to 40, and anything below 50 is definitely bearish territory for the builders. Now, also of note, back in April, we saw a shift in construction. Developers are pulling back on multifamily construction, and they're increasing single-family home construction. So for the real estate market in general, I think that's a good sign. Although I will note that builders are making concessions in order to boost sales. So that's kind of a worrying sign, and thus they're lacking confidence. Now, as far as realtors are concerned, the biggest drop in confidence is in buyer sentiment because of the interest rates and the prices. Only 8% of realtors surveyed indicated that they thought buyer demand was going to be strong. But on the other hand, realtors do have a little ray of sunshine in the fact that listings are selling quickly, but the competition to win the listing is pretty fierce at this point. Now let's take a look at recent news from the Fed. Chairman Jerome Powell gave a speech on Thursday at the Economic Club of New York. Interesting little side note, his speech was delayed briefly by a small group of climate change protesters. So they escorted the chairman off the stage while they dealt with the situation. And I think it was only like 5 or 6 or 7 protesters. It wasn't a big group from what I heard. But they got them cleared out and then brought Chairman Powell back out, and he was able to deliver his speech. Now, his speech was watched very closely for any hint of what might occur 9 days from now at the next Federal Open Markets Committee meeting. Powell said, "We are attentive to recent data showing the resilience of economic growth and demand for labor." He added that the Fed is proceeding carefully. At the same time, he asked the rhetorical question, "Is policy too tight right now?" He answered himself by saying, "I would have to say no, policy is not too tight right now." Now, different folks have interpreted those comments differently. A lot of people took it to mean that the Fed will pause interest rate hikes one more time on the October 31st / November 1st meeting. I'm not so sure. His well-known hawkishness and his statement that policy is not too tight right now gives me pause. And Powell also has been quoted in the past as saying he wants a reset in the housing market. And let's take a look at that quote as well. In a September 2022 interview, he said, "When I say reset, I'm not looking at a particular specific set of data. What I'm really saying is that we've had a time of red-hot housing market all over the country, where famously houses were selling to the first buyer at 10% above the ask even before seeing the house. That kind of thing. So there was a big imbalance between supply and demand. Houses were going up at an unsustainably fast level." He continued on, "For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. The housing market has to go through a correction to get back to that place." Well, unfortunately, in my humble opinion, the Fed's actions have had exactly the opposite effect. By raising interest rates, they have forced the mortgage rates to record levels. Well, not record levels, we all remember. Well, I guess we all aren't as old as I am. I remember Jimmy Carter and 17% mortgage rates. But in any case, he's forced interest rates up very high. And because of the locked-in effect, we have people that won't sell. And the supply is nowhere near the demand, which he stated he wanted to get supply and demand in balance, but the policies that the Fed is pursuing are certainly not going to drive supply and demand into balance. The only thing that is going to do that is reduce the interest rates to a more reasonable level so that people are willing to sell, and that should bring about the needed correction in supply and demand. Now, the other thing about it is, and I mentioned this last week, core CPI is in fact hanging right around 3.8%, if I remember correctly. It's in that ballpark. A major component of the core CPI is in fact housing cost, or as it's referred to in the report, shelter cost. But if you drive up the cost of housing, you also drive up the core CPI, And that's exactly what he's trying to avoid, is a high core CPI. So that's the other way that they are having a negative feedback loop. So prices have continued up, interest rates have continued up, and core CPI remains stubborn, although it is certainly down from where it was. Now let's take a look at the average 30-year fixed rate mortgage. We had some hope of a little bit of relief at the end of August. The rate dipped down from the 7.5% it was at to 7.08%. And there was some hope that it might continue on down from there, with a lot of people hoping for 6% even. However, the 10-year U.S. Treasury yield jumped up to almost 5%, and that in turn put the pressure on the mortgage rates again. So now we're at 8.03%. So yes, we finally broke that 8% barrier that we've been trying to avoid. The consensus is that the probable cause is uncertainty in the direction that the Fed is going to take in terms of monetary policy. Are they going to pause? Are they going to continue to tighten? I don't think anybody really expects that they're going to relax rates any at all anytime soon. And the other factor is the inverted yield curve on the Treasury bonds. However, it is worth noting that the last time the Treasury bonds were at this level, the mortgage rates were 100 basis points lower, or in other words, 1% lower than they are now. So it's just an uncertainty in the market has got people nervous. Now, it is worth noting that the futures market has priced in a 4% possibility of a rate increase on the October 1st meeting of the Fed. So in other words, they're basically expecting a pause, and that's certainly different than what the Fed was indicating at their last meeting in September. Generally, it was thought that they had pretty well made up their mind to do a 25 basis point increase on this meeting on October 31st. However, at the same time, the market has got a 34% probability of a 25% basis point increase at the next meeting of the FOMC, which will be on December the 13th. So before I close out with a couple of quotes, I'd like to say if you've enjoyed this program and gotten some useful information out of it, then please like and subscribe. And with that, let's have those quotes. The first one is from Robert Dietz. He is the National Association of Home Builders chief economist. And he says, "The housing affordability crisis can only be solved by adding additional attainable, affordable supply. Boosting housing production would help reduce the shelter inflation component that was responsible for more than half of the overall consumer price index increase in September and aid the Fed's mission to bring inflation back down to 2%. However, uncertainty regarding monetary policy is contributing to affordability challenges in the market." So there you have it. Mr. Dietz, or perhaps Dr. Dietz, I'm not really sure. I should probably look that up. Probably Dr. Dietz, I would imagine. He's a PhD, I would be almost certain. But in any case, whether he's Mr., whether he's Doctor, doesn't really matter. I agree with him that if they just lay off the dadgum rate increases and let things settle down a little bit, the inflation would come down all on its own because, as he said, the housing component was more than half of the CPI increase in September. And bear in mind, CPI is at 3.8% for the year. So chopping the monthly increase by half would bring it a long way toward bringing the yearly rate toward that 2.0% mark they're looking for. So with that, the final quote is from, and I'll just assume, Dr. Lawrence Yu. He is the National Association of Realtors chief economist. And as has been the case throughout this year, limited availability and low housing affordability continue to hamper home sales. The Federal Reserve simply cannot keep raising interest rates in light of softening inflation and weakening job gains. Well, I do agree that inflation has come down, so you could call that softening inflation, certainly. Uh, Weakening job gains, we had 336,000 new jobs this month. So, yeah, that's not a real weak job market. And as I say, there's 9 million open jobs waiting for somebody to fill them. So, I'd have to disagree with Dr. Yu on that one. But in any case, I want to say thank you for stopping by and listening to me, and hope I didn't rant and rave too much, but yeah, I get worked up a little bit. What can I say? So have a good week, and I'll look forward to seeing you next Sunday.